Welcome back, friends, to Alpha Beta Soup. I'm TXMC. We've got a few things to talk about today. We will look at Bitcoin and some of the on-chain data. And the second half of the video, I'd like to talk about inflation and the national debt and what I think is going on with the markets. So we'll talk about what I think is happening. We'll look at some interesting reading that I found during my research, and I'll lay out some of my thoughts for why I feel it's relevant for the markets. If you enjoy my content, make sure to give this video a thumbs up and subscribe to my channel. We recently shot past 10,000 subscribers, which is utterly incredible. Thank you so much for all of the support. In case you missed it, last Friday I made a guest appearance on Blockchain Backer's channel. I'll leave a link down below to that video. He had me on as a guest and we ran the gamut talking about on-chain and Bitcoin, and I think you guys will really like it, so make sure you go check that out. Big thanks to him for having me on the channel and for always being a big supporter of my content. Thanks, BCB. Appreciate it. So let's get into the charts. Well, Bitcoin, for its part, has not done much since the last time we spoke. Still very much range-bound here, around 40,000. And the disrespect of the $40,000 price level has been palpable. If we go here to an intraday chart and we look at the last few weeks of price action, basically since we broke below 40,000, we have ripped back over 40 and then rejected it just a few hours later 3 different times during this period. So as price began to curl up here at the end of last week and retest 40,000, I was on the lookout for a 4th rejection of this level, which would be an exceedingly weak look, and I tweeted about this last week. But to my pleasant surprise, we've actually seen some mild strength here. We saw a bounce off of this $40,000 level. Now, it's still far too early to make any proclamations about directional change. But if we're just looking at the price action in the few weeks prior, lots of rips and dumps, this sort of constructive grind higher with higher lows being set periodically, this is constructive price action. So it is a positive. And one thing that we've talked about on this channel being a possibility for price action once we finally break out of this range, which will happen eventually, is the risk of a retrace rally. Now, these play out in assets all the time when there is a pullback from the high from a recent breakout. There is often a consolidation period and then a retrace. And in many instances, those retraces run out of steam right around the 702 retracement, which is about 70% of the original move. That price for Bitcoin is around 58,000. And retraces to the 702 happen all the time. They happened here in May of 2021 as we were pulling back from the all-time high before the market dumped down to 30K. This also happened in 2019 after pulling back from the high during the Plus token Ponzi rally. Price actually got up to the 702, then broke out to the 786 before ultimately rejecting down. Got a little higher than the one we just looked at, but again, similar place, 78% of the move, then rejected. So we know these structures can play out. And with inflation expectations being where they are, with the geopolitical landscape being such a mess, with commodity shortages seeming like a very real possibility this year, there's a lot of headwinds playing against the likelihood that Bitcoin breaks out into a new bull run this year. And I'm just a guy, right? I can't predict the future. All I can do is try to lay out factors and make my best assessment. And when I look purely at the price action and I take into account the economic and geopolitical factors that would play against the market, particularly risk-based markets, a retrace up to this level seems more likely to me than a bull run to new all-time highs at this moment in time. I think we've still got a lot of work for the markets before we can feel confident that a risk-on attitude will be sustained into a new bull run. If developments start to unfold, if the market starts to shift in its sentiment, if there's any hint that inflation could be slowing down or peace is coming out of Ukraine, things like that could have a very positive impact on markets broadly, and we might see sentiment shift. But for us to break through this level, to defy history, we would need to see sustained bullish spot demand for physical Bitcoin. We would need to see high volumes of supply changing hands on chain as we typically do in a bull run, and we would need to see those levels sustained through this rally as we break through each of these retracement levels. So that's just broadly kind of what I'm looking at with Bitcoin. I can't predict the future. I'm not telling you to lock in the likelihood of a retrace and a crash or anything like that. But if I'm trying to base my expectations on history, these are the things that I can lean on. And of course, I'd love to be pleasantly surprised to the upside, and we will continue to analyze the market all throughout this process and make sure that our expectations are matching with our observations of the market. That's a long-winded way of me saying I don't know what's going to happen, but I think that when price gets back towards 55, 60K, it's going to be extremely interesting. Now, if we pop over here and we look on chain, here is the spent volume age bands. Now, this is showing volume transacting on chain each day from coins that are at least 1 year old. I've filtered out anything that is less than 1 year. So anything transacting right now is at least from March of last year or earlier. After many months of a relatively quiet period for this metric, we have seen an increase just in the last couple of weeks of 1 year and older coins being spent. If I zoom in a bit here, you can see the rise. This is with a 7-day exponential moving average. Now, in terms of percentages, this isn't a huge percentage of the daily volume on chain. You can see it's about 1 to 2% of volume. But the spike visually is noticeable, and it's higher than most of this period during the drawdown. You can kind of ignore this one anomaly here at the beginning of February. This was actually from the Bitfinex hack, from the coins that got moved and seized by the US government. So you can kind of ignore that. It's been mostly quiet, and then recently a surge of older coins being spent. Could that be de-risking? It's hard to say exactly, but this isn't the kind of trend we'd like to see sustained. I wouldn't want to see this rise and stay as a block of spending of older coins. Hopefully it's an anomaly, but it is something to pay attention to. It's worth noting. If we look to corroborate the movement of those older coins with realized profits, we're not seeing a lot of signal here. I would expect that if there were coins older than a year being spent, they would probably be coming from lower prices, and I would expect to see a high amount of profit realization on chain, signifying coins moving from a much lower price now at a higher price. But when I look at profit and loss, if we zoom in a bit here, there isn't much of a trend. It's still kind of a sustained chop in this condensed range we've been in for most of 2022. So no real signal here on profit and loss, which suggests to me that these older coins that moved must have been from the relatively recent past. So they're at least a year old. Maybe they're from right here. Maybe they're from almost break-even price, and that might be why we're not seeing a high corroborative print on realized profit and loss. Keeping an eye on this dynamic over the next couple of weeks. It's something that's got me intrigued. I want to spend a few moments talking about inflation. On Monday, Jerome Powell expressed some very hawkish sentiment in some comments at the National Association for Business Economics, where he expressed a willingness to raise core interest rates more aggressively and faster than the market is prepared for. He's laying the groundwork for the possibility of a 50 basis point hike in May and potentially more in the summer. Now, while those comments are meant to tell the market that the Fed is serious about fighting inflation, the market itself is showing signs that it doesn't believe Jerome Powell can do what he says he'll do. What do I mean by that? Well, since he gave his comments last week, where he finally confirmed the 25 basis point rate hike, the markets have pumped. All the major indexes have been pumping since then. The 10-year Treasury yield continued its march higher as bonds sell off. Gold as well has remained completely flat during this time. No bid whatsoever. And what I think may be going on is the market may be wise to Jerome Powell's antics at this point. And I think that they are calling his bluff. I think investors know that the Fed cannot reasonably fight inflation at this point without causing a recession. And I think the market is betting that Jerome Powell will not be willing to purposely trigger one. So what does the market know? Why do they think Jerome Powell is bluffing? Well, I'll do my best to try to explain that. Here is a look at federal debt as a percentage of GDP in this blue line. I took this chart from linalden.com, and I highly recommend you check out her site if you'd like top-shelf economic research. Now, if you look at the value where it is now, it's about 125, 135% of gross domestic product. That value is the highest it has ever been, higher than it was in World War II. When debt levels get over 100% of GDP, the options available to a sovereign for dealing with that inflation within their own borders and within their own currency are very limited. And there have been moments in history where this has occurred and we can use as reference. Let us first consider this study from Hirschmann Capital, which says that since 1800, 51 out of 52 countries with gross domestic debt greater than 130% of GDP have defaulted, either through restructuring, devaluation, high inflation, which is what we have now, or outright default. It goes on to say, contrary to popular belief, the Fed cannot pay off the U.S. government's debt by simply printing money. Printing would cause hyperinflation, like 1920s Weimar Germany and Venezuela. Hence, the Fed has funded its bond purchases by borrowing rather than printing. The catch is that the Fed will be trapped if Treasury yields spike due to a debt crisis. So what is this saying? This study is basically saying that over 130% of GDP is a borderline unrecoverable level in the history of sovereign money. And we are currently at that level. Now, with Treasury spending, pay-as-you-go entitlements, and defense being higher than total tax receipts, the flexibility of the federal government to deal with inflation through monetary policy is very limited. But there has been a playbook for how to deal with these things. And it might shock you at what it suggests governments do to deal with high inflation. This paper is called The Liquidation of Government Debt, and it is printed and published on the website for the International Monetary Fund. This is a public document. I will leave a link in the description down below for you to see it for yourself. And it describes the sovereign playbook for crushing government debt in periods of high inflation by melting the purchasing power of holders of the currency. We won't go through this entire paper together here on the video today, but I will go through this abstract with you, which gives the summary. And it says, high public debt often produces the drama of default and restructuring, but debt is also reduced through financial repression, a tax on bondholders and savers via negative or below market real interest rates. Financial repression is most successful in liquidating debt when accompanied by inflation. We suggest that once again, financial repression may be part of the toolkit deployed to cope with the most recent surge in public debt in advanced economies. Now, this paper goes through about a dozen different countries, and it focuses on the period from 1945 after World War II into 1980. And it suggests three major strategies for how a government can deal with high debt and high inflation simultaneously. Those three bullet points are, number one, hold real interest rates below inflation. Number two, require institutions to hold and purchase government bonds via legislation. And number three, monetize the debt whenever possible. Now, all three of those major bullet points are playing out in real time right now. Now, despite what Jerome Powell may think he can do by raising interest rates aggressively in the face of this high inflation, what he would be doing by raising the cost of borrowing is tightening the credit markets at a time of slowing growth and exorbitant debt levels. Regardless of what Jerome Powell may express, history is against him. 51 out of 52 countries in this exact situation have ultimately defaulted or had to allow inflation to run hot. This playbook is literally published by the International Monetary Fund, and it says, let inflation run hot, force people to hold negative real interest rate bonds, and continue monetizing the debt whenever possible. I think the market knows that Jerome Powell can't raise interest rates very much. He cannot meaningfully raise them up to the point where they would be even with inflation, because it would absolutely crush the credit markets and it would cause a debt crisis. He would force a recession by doing so, and I don't believe that that's in his best interests. So what I think we may be seeing is a lot of aggressive, hawkish posturing, trying to get the market to do some de-risking on its own while the market is calling his bluff. It's an interesting dynamic playing out. I certainly can't see through the tea leaves. I'm just an amateur person on the internet trying to understand the world. But when I see something like this liquidation of government debt paper actually describing to a perfect T what the Federal Reserve is doing right now, it's hard to believe that they're going to enact some new strategy, not when history is against them. So I'll leave these resources in links down in the description if you'd like to do some reading on your own. I encourage you to leave feedback for me and comments if you're curious to talk about this further. If there are any economists listening to this that feel I've got some of this wrong or think that there's something else I should go read to supplement my own education, please let me know, because this is a very important and interesting topic. And in the meantime, we'll continue to watch this circus unfold. It's hard to imagine that Jerome Powell and the Federal Reserve would willingly trigger a recession in an election year. And it feels like the market is calling that bluff to his face. So we'll see how it plays out. But all right, that was what I wanted to cover today. We're seeing older coins spending on chain for Bitcoin, but it's not manifesting itself in high profit taking, and it seems that price action is able to uphold that sell side. It also feels like the market is calling the Fed's bluff and that it doesn't believe they're willing to continue raising rates as aggressively as they say. We'll have to watch how this plays out over the coming months, but I believe that if inflation remains sticky, if we continue to see commodity shortages, this issue will only get worse, and the Fed has almost no good options available to it at this point. Make sure you're following me here on Twitter at TXMC Trades. I post a lot of my thoughts and analysis, and it's where you'll find out about any content I'm contributing to that isn't on my YouTube channel. As I've mentioned before, this Twitter page and the YouTube you're watching are my only sources of content. If you get an email from anyone pretending to be me, it is a scammer. You should ignore it and report it. But that's it. I'll let you guys go, and we'll talk again later this week. So until then, take care of yourselves, friends, be kind to one another, and we'll chat very soon. Cheers.